So let's continue with various other miscellaneous things with regard to partners and their relationship with the other partners and relationship uh, with the outside world. Number one, of course, there is a right to an accounting. Accounting means a right for the financial information, a right to look over the books and make sure if one partner suspects that one partner has gotten too much, or one partner or that person has gotten too little, or there have been information that hasn't been properly shared, or for really whatever reason, each partner has a right to see the books of the company, to see the balance sheets, to see the income, to see the outflow, to see whatever money was made, to see whatever money was spent, etc. They can bring an action. Each partner can bring an action for an accounting. Either they can ask to see the books directly, or they can literally go to court and ask the court to force the other partners, whichever partner is actually taking care of the books and taking care of the money, to ask for a formal judicial accounting, in which they can review the partner's transactions and award each partner his or her share of the partnership assets. If the court believes that one party has not been paid appropriately based on the partnership agreement or based on the default rules, the court can order the parties to, to get paid what they're supposed to be paid. The next issue is this idea of tort liability. Torts, for those of you who may not be familiar, means when there's some sort of an injury suffered by someone, in this case by a third party. The question is, who is liable? And the answer is, everybody's liable when you're talking about a regular general partnership. Now, we're going to discuss a little bit later on how when you're talking about different types of entities, there's a limitation on liability. But generally speaking, when you are talking about liability, if the partnership commits a tort, in other words, if the partnership business is sued, let's say the partnership has a restaurant and somebody chokes on a foreign object that's in the food, or there's food poisoning that somebody gets, and the person files a lawsuit against the restaurant. Well, everybody is liable. Everybody, all the partners are liable. Partnership is liable for the tortious, which means committing a tort, which means damaging acts of a partner, employee, or an agent. In other words, somebody who works in the restaurant or somebody who's hired by the restaurant, if they're working within the ordinary course of the partnership business. There's a general tort rule that if I own a business and somebody commits a tort, somebody commits damage while working on behalf of the business, I am liable. And that's the general rule when you're talking about a general partnership, and that is that the partners are personally liable for whatever happens in the context of the business. The way they are liable is sometimes known as joint and several liability. Joint and several liability is a concept that says each partner is fully liable for whatever injury there is. Now, of course, that doesn't mean that each partner has to pay 100%, meaning the person that's sued gets 400%. If there are four partners, A, B, and C, and D, and the victim at our restaurant suffers $100,000 worth of damages, that, of course, doesn't mean we each have to pay $100,000 and that the plaintiff walks away with $400,000. I mean, that would be very nice for the plaintiff, but that wouldn't make much sense. Instead, what it means is we're each liable for 100%, to the extent that if one of us is not around or if one of us has no money, then the others have to make up whatever difference there is. So if there are four partners and there's a $100,000 judgment, we would each owe $25,000. However, what if partners B, C, and D all skip town, or they have no money, or they can't pay for whatever reason? Well, then partner A would be responsible for the full $100,000. That is a concept called joint and several liability, and it applies in general whenever you're talking about two or more people that commit a tort. If you have two people that together beat somebody up or together, injure somebody through negligence, they are joint and severally liable, which means they're both liable for 100% of the damages. The normal rule would be that they split it and each pay half. However, if one cannot pay for whatever reason, or if one is beyond the jurisdiction of the court, if one, doesn't live in the United States and the court doesn't have jurisdiction over the person for whatever reason, then the other person partner who committed the tort, or in this case, the partner of the business, would be fully liable. So if you have three people that own a hot dog stand or three people that own a restaurant and the person gets injured and two of them can't pay for whatever reason, or two of them skip town, two of them there's no jurisdiction over, whatever it is, the poor third person is going to have to pay for the entire thing. That is the concept of joint and several liability, and it applies to a partnership. Then we've got the idea of contract liability. Well, if the business signs an agreement to order supplies, or to rent an office, or whatever it is, well, who's liable for that? And the answer is all of them are, right? That's really the same rule with regard to torts. We just discussed that rule with regard to torts, and now we're going to discuss the same rule with regard to contracts. If the company duly signs a contract, the partnership orders an office, let's say 5,000 feet of workspace for a year for $100,000, well then that contract, all of the partners are individually liable for it. I think you can start to see why it's a good idea to have one of those other business forms that we're going to discuss a little bit later on, wherein you have a limitation on liability, wherein you have a situation where the partners are not necessarily fully liable each for the for the company's debts, because the default rule is that each partner is joint and severally liable for the entire debts of the company. There is one minor distinction between contract and torts liability. The third party has to name all partners in the lawsuit rather than just suing the company. You have to sue the people individually, and a successful third party can collect judgment against any or all of the partners. So again, here's a chart with some of the slight distinctions, but I can tell you in general that the rule is that you can sue any or all the partners, and of course the partners can fight amongst themselves to make sure that they split any debt equally. If there are 4 partners and there's a $100,000 judgment, well then they have to each pay $25,000. Let's say B, C, and D are out of town, or B, C, and D are run away and they don't pay the money, then A has to pay the entire thing. But then of course A can turn around and collect his or her what is called indemnification from the other partners. And indemnification means, well, like indemnify, like an insurance company. They get to get their money back. In other words, partner A can then turn around and sue partners B, C, and D each for $25,000 for their individual shares. What about an incoming partner when you're talking about debts that already existed before the partner comes in? We've got A, B, C, and D are partners, and they owe this judgment of $100,000, and then they take on partner E during the lawsuit. Either partner E doesn't know about the lawsuit, or partner E does know about the lawsuit. The question is, what is partner E's liability? Is partner E liable for these what are called antecedent debts? And antecedent in this case means debts that occurred before E's interest in the partnership was established, or not? And the general answer, I think you probably could figure this out, is that the new partner is liable for prospective debts, in other words, liable for debts that come in the future. And of course, the partner can lose his or her contribution to the partnership if the partnership goes under, or if the partnership has to pay all of its money for a for a lawsuit. However, the new partner is not personally liable for debts that existed beforehand. So for example, while the partnership has a $100,000 debt, E comes in and pumps in $50,000 to the partnership as a new investor. Well, that $50,000 of course now belongs to the partnership, and so that $50,000 can be used to satisfy whatever debts there are in the partnership. However, E cannot be sued personally in addition to that, for E's personal assets, for something that happened before E ever even got involved in the partnership, which I think is a fairly commonsensical, if that's a word, rule. So the new partner is personally liable for debts and obligations incurred by the partnership after becoming a partner, but not before becoming a partner. And finally, with regard to a partnership, we are going to look at dissolution, which means ending a partnership.